Good afternoon, and welcome to the wrap-up for round 4, competitive round 4 of your cap sim. Um, I hope everybody has settled in, and aside from my homework assignments, at least started to enjoy playing the game a little bit and the competition that it involves. So at least I hope that's the case. That yeah, maybe at least I could go so far as to say enjoying it relative to say an old-fashioned lecture and test type of a course. I hope it. I know it is for me much more um, enjoyable to participate in a game like this, a simulation game, as opposed to uh, lecturing and giving tests and correcting said tests. So hey, let's go take a look before we take a look at this week. Let's go take a look at last week's assignment. And I haven't had a chance to glance at your guys' answers yet, but I'll run through what I saw. So for the assignment for round 3C, it said how much excess capacity will there be next round in the performance segment? And this was something you might want to start paying attention to as these competitive rounds roll on. Excess or lack of capacity can be they can be big factors. They can create opportunities or unopportunities, whichever the case may be. So it's something that you ought to kind of watch for. Anyhow, if I added it up correctly, there was 691 units or 691,000 units in inventory. Again, if I added it correctly, there was 3,300 units of capacity available for the first shift, and so times 2 would give us 6,600. So the total available capacity then would be those two added together, which is 7,291. The demand next year, I've got this year's demand was 3,321,000 times a 19% increase, 19.2% increase, or just multiply that by 1.192, should give us a demand next year of 3,959,000 units. So the excess capacity then would be what we have available, close to 7.3 million, minus the close to 4 million, so about 3.3 million, 3,332,000. You could, and if any of you were, that would be great. You could be a little bit more specific, because if you remember, there's always I think it's a 1% reduction in the amount you can produce based on your capacity, just based on seconds or product that doesn't meet standards. It gets thrown out. So technically you could take 1% off of that, or 66 units off of that, which would take 66 units off of that as well. If you did that, I might even be inclined to give you a couple bonus points, because that's taking it a little further than I would have expected. So question 2, how much did Ferris miss out on the low end in unit sales and before tax profits? So I wanted each of those. So I had to break it down. And I guess I didn't do a very good job of showing my work here. Shame on me. I hope you did a little bit better. But there's 2 units that Ferris was selling in the low end of both feet and fast, and we'll take a peek here. Fast actually sold more than its potential. Okay, so I set it aside for the time being. See, here we go in the low end right here. And fast sold 4.8% actual, and it had a potential of only 4.1%. So it actually sold more, right? Whereas feet had actual sales of 11.1 and had potential sales of 20.1. So let's concentrate on feet, and I'll come back and talk about fast a little bit. But so 9% is what feet missed out on. And if I take 9% times, I have to cruise up here, times the total industry unit demand of about 12.5 million. Take 9% of that, it's going to be, something over a million, right? And if I do my math here correctly, it's 1,125,630 is the number of units that they could have sold for feet. Okay. it sold for $21.50 a unit, feed did, and so total sales, which is my second question, could have been 24 million, an additional 24,201,045. Now I need to, in order to determine my before tax profit for that, I need to calculate my material cost, which if I look up above is $5 for feet, $5.49, and my labor cost, so I don't have to come back, is $7.61. Oops, and I multiply each of those by my units that I missed out on, okay, because that would have been my cost, my material cost, and my labor cost would have been those, and so that comes to about about 14.7 million, 14.6, 14.7 million, something like that. And then I subtract that from what my total sales would have been, and so my total earnings before taxes that Ferris missed out on just in that one segment was 9.4 million. So fast would have been a positive number. You know, it's sold, man, sold. I think I meant to hit a D. It sold more than potential in this segment. So technically, Ferris didn't miss out on any because of fast. It kind of offset it. If you went through and did the math, you'd have done it in a similar way, but it would have had a positive effect versus a negative. If you did the math, bully for you. Again, I might be inclined to, if you properly expressed it, be inclined to even give you a little bonus, but if not, no problem. So 3, Ferris invested about $28 million in plant improvements. What is the immediate effect on profit? This can be shown in numbers, but numbers are not absolutely required. But be sure to fully explain your reasoning. And what I want you to be doing is just thinking about this. You know, investments in plant are not expenses, okay? At least not the way the government allows us to account for those at this time. Okay, investments in plant are simply an exchange of one asset for another. There are some effects, and that's kind of what I wanted you to think about. So the negative effects on profit, right, might be depreciation. Not might be, it would be depreciation. You're going to have $28 million more in plant that you're going to depreciate. That's a lot of plant. I mean, my guess is that it's going to create a decent sized amount of depreciation, probably somewhere $1 million to $2 million maybe per year extra in depreciation. I'm not sure what depreciation schedule they're using. Okay. Second thing might be, and I said this is possibly, usually I want you guys to be certain, but in this case we can say it's possibly interest depending on the need to borrow. So if Ferris had plenty of cash, they wouldn't have needed to borrow maybe for the $28 million, but if they borrowed for that $28 million, it would certainly have created an interest expense then that would have had a negative effect on profit. Okay, so depreciation is absolutely interest is possible. And then thirdly, I said its EPS might have gone down. Okay, not really an effect on profit. So this one, wouldn't necessarily have to have it in there for sure, because that's just kind of a maybe. In fact, I'm going to do this just so I know. Kind of highlighted here a little bit. Okay, but its EPS, earnings per share, would have gone down if it had sold stock in order to finance that. But those are all offset because there's positive things as well, right? It could have sold more. If it created more capacity, it could have created the ability for it to produce more, which it could have sold more. And we could probably get into a little longer story here too, and if you did, that's fine. The longer story being too that, you know, maybe it invested in automation and some things that would cut costs, and if it cut costs, it might have been able to lower its prices and thus sell more and still have a, you know, on and on and on. So we could have gone on and explained that even more. Okay, but more sales potential would be adequate. And then secondly, it possibly reduced labor, and it probably absolutely reduced labor costs, but they would have possibly made it unnecessary for some second shifts, depending on how much production they were going to do, right? And it possibly a reduction in automation, and we could go check and see if they actually invested in automation. If they invested in automation, this one would be an absolute that it would save money, you know, in labor costs due to automation. perhaps fully offsetting, interest costs or depreciation. Okay, sales potential too, I should add too, if they were introducing a new product, which for Ferris might well have been. And I could and should probably go back and check that, but certainly a new product is going to have new sales potential in this industry. So, okay, so just some negative and positive things to really think about when you're doing plant improvements. I think that we're getting late enough now. I think that a lot of teams are really hesitant to do that because they think of it as an expense, but nothing could be further from the truth. Investing in plant, if you have, again, if you're investing in plant just for the sake of having plant, that doesn't do you any good, right? If you have plant that's sitting there idle, not using it to the full second shift, that's idle, and there's an expense that's kind of unseen to that, right? But if you're investing in things like automation and such that are actually creating value, wow, okay, then that value is probably certainly, how's that? Certainly going to offset depreciation and interest costs. 4. What would Ferris's ROE have been if it had a cash position of exactly 0? For example, if it paid out all its cash in a dividend. Again, we had this one before, and people did poorly on it, so I'm hoping we picked up on that. And the idea here is, again, it's not just this cash thing, although that's part of it, but it's that as an investor, you want a high return on equity, and there's a couple ways to accomplish that. One is certainly through higher net income, but the other then is also lower equity. Now, and I'll show you a little later that lower equity can have some risk, but it's balancing that's really important, and that's the important job of a CFO if a person ends up landing in that type of position. But our equity for Ferris was $67.1 million. His cash was $35.7 million. So if you just subtracted out the cash, right? Because if it was all paid out in a dividend, then assets would decrease, and as a result, liabilities or equity would have to decrease, and in this case, it would have to be equity. Okay, so its equity would have gone down to $31.5 million. And thus, its net income was, this is net income. I should probably put that in there. Net income, okay, is divided by the new equity, and its ROE would have been close to 40%. Okay, and its ROE actually was 18.4%. So we could have more than doubled its ROE actually by managing its cash a little bit better. Okay, now I add, and that's important, I think, that in my scoring system and in real life too, Ferris would have been penalized some for maybe having high leverage and also low in this case working capital. And in real life that can be the case too. You have to balance those things. There's a safety net, if you want to call it that you need to have in terms of capital and equity that's on hand, in order to cover things or take advantage of maybe opportunities that could come up. So, okay, that's it for going back and taking a look at 3. So let's look at the results for 4. And I'm probably going to go through this a little quicker than I have in the past, or at least that will be my desire, because at this point in time I hope you guys have picked up on some of this. Andrews had a poor round. If I had to guess, there might have been some wrong buttons pushed, but that's just a bit of a guess because they had a really poor round in terms of sales. Look at that, only 46 million in sales, whereas every other team was well over 100 million. Baldwin, relatively poor round as well. Emergency loans across the board, with the exception of Erie and Ferris. And Erie had a nice round here, having sales close to what Ferris's were, and had a profit, whereas all the other student-run teams did not. Ferris had a big profit. This is the point of the semester where I always get worried about whether or not my student teams, which I fully anticipate, will catch and bury the computer team, which again I fully anticipate, but I do start to worry about it at this point in time. So I'm hoping that you guys have picked up enough. I'm seeing a few signs. I'm seeing a few signs that at least a team or 2 or 3, maybe So we'll see if they pull it together and do the things that are necessary to bury the computer-led team. So, stock outstanding, earnings per share, obviously with the profits, Ferris and Erie were the only two that had positive earnings per share, and we see some pretty mixed up results down here in terms of stock prices. Andrews and Baldwin hanging down there at the bottom. Digby looks like fighting to join them. Chester and Erie certainly keeping their head above water, but they got a ways to go to catch Ferris. So cash flow. Ooh, but look at this. Okay, Ferris invested all kinds of money, so meaning it's going to be perhaps even more difficult to catch them, but we'll see. Erie also invested a big chunk, but really, and then Digby some, but boy, not much. And you see Andrews, Baldwin, Chester. Chester actually looks like they sold some, right? We've gone through that exercise before in order to net positive cash, okay? And so we'll see if these investments for Erie and Ferris, are going to pay off. And impressive that Erie and Ferris again, and this kind of went to my question from last time in terms of, here they made plant improvements, and yet they were the winning teams. And so it obviously didn't have a huge effect on its short-term profitability. Not a huge negative effect anyhow. It might have had some positive effect on short-term profitability if we sharpened our pencil. Okay. That's kind of interesting. Erie bought back a little bit of stock. So even though it has quite a bit of stock outstanding, it actually bought it back. So I think something I've kind of hinted about. So, and then they issued a little bit of long-term debt. Good job of managing cash. Yeah, Erie's only got $2 million. Ferris has got hordes of cash. Other teams obviously have negatives or zero cash here, but because of the emergency loan, they have zero cash or negative cash, I guess I could call that. So, but Erie, yeah, cutting it kind of close. You guys can wipe your brow and breathe a sigh of relief because you did end up in the positive, but it was kind of close. So, and total fixed assets. Look at that, small. Erie is a big company, even bigger than Ferris. Okay. Which is kind of interesting, but those teams have big sales, and so we'll see if they continue to need those for their big sales. Ooh, accounts payable. Now, why, if Ferris had I should ask that question. That'd be a good question. But why, if Ferris had so much more in sales, does Erie have a higher accounts payable? That's interesting. And that is interesting. Okay, I know the answer, but I'm wondering if you guys do. It might be something that would be worth looking at. So, current debt, not a lot of current debts. So Erie hasn't borrowed much in current debt. I think Erie might have had a little bit of, they had just that little long-term debt there. They do have some other, long-term debt that's outstanding. So they get a decent amount of long-term debt as compared to the other teams. What else there? Total liabilities. Yeah, big liabilities here, but again, those are factors of the emergency loan primarily. Common stock, a lot of common stock. So Erie and Chester had sold, a lot of common stock at some point in time. Total equity, big number here for Ferris, right? Makes it tough. It's ROE. Here we've got the total equity. Here it's almost twice as much. Now, Ferris had a big profit, far greater, a little over twice. So, their ROE, even though the profit was way more than twice, their ROE is fairly close. Okay, so that's pretty impressive. For me, as an investor, I'll take good ROE. We finally see 3 companies, at least, using a little bit of capacity. Of course, Ferris and Erie, they're not getting penalized by having unused capacity, excess capacity out there, and that's probably why they were kind of successful. Chester making kind of a bold pitch there. So come down, I'd pay attention if I were you guys to the inventory. Andrews had a horrible time selling some stuff. I might have asked a couple questions about that in the assignment, so I'm probably not going to get into that. And again, I'm sort of wondering if we might have had some missed input, which would lead me to tell you that you ought to make sure you go back and check your inputs and whatnot. Contribution margins on items. Look at that. Look at that. Tiny, tiny Chester. Just tiny. You know, why'd Chester have such tiny contribution margins? That's really interesting. 4% on that traditional product, right? And only 24%. Still not that great. So tiny, tiny contribution margins. We'll see. I know all three of these products, right, have transitioned from high performance and size into the traditional. You know, so that's certainly going to have an effect, and it does. But why is this the traditionally low product instead of traditional, but really not much of a contribution margin there? Nor does Dell have a very good contribution margin there in the low end and in some of these other categories here. Whereas when we come down, we look at Erie. Man, look at that. You know, 20s a low, and you got some 23s and 22s here, but look at that, 53%. And they sold a lot of units, right, with a 53% contribution margin. So that's like a wow. And you guys might want to pay attention to how that's happening. I'd be paying attention to how that's happening, okay? And in fact, I think I asked you a question in the assignment. So, you know, why is Chester dominating in the traditional market? Again, they've got 4 products. Okay, it kind of looks like Andrews is trying to position itself similarly, okay, but didn't take advantage, maybe for some reasons again that you guys ought to take a look at, okay, and try to figure out. But Chester kind of dominated there. Ferris isn't even playing in that market. Okay, almost none. You can see their product here is transitioning into the low end. And the rest of the teams are all, you know, just kind of taking a marginal share. Get to the low end, and Erie kind of dominated there. Okay, interestingly, but not a huge domination. We see a lot of teams did okay. You know, that 15-16%. Andrews fell back there, and you might want to ask yourself why. Hang on. Okay, sorry I had to pause and I kind of forgot where I was at. I think I was just talking about potential and those types of things in these different areas. We see Ferris dominating the high end. You know, they're out here, tough to catch. You know, when we get this late, it's tough to move your product. Although Erie might have done some things that'll allow it to make a push, and I'll talk about that maybe as we come down here a little bit further. Erie's dominating both the performance and along with Ferris dominating the size segment. So looks like Digby's staying in there. If you remember back to our practice rounds, you guys kind of gave up and seeded CEDED, the tie end categories to Ferris. You know, didn't really compete up there, and so it's kind of good to see, you know, that there is some competition. So actual versus market, again, the real numbers down here, not just the estimates from up above. Again, we should be able to kind of take a look at this and see where teams are at and where they're competing. It's really kind of, you know, I thought in the practice rounds that we had this huge bundle, you know, here in the traditional. It's almost like there's blank spaces here in the traditional segment now. It's really kind of odd. I mean, there's 3 products that are kind of close to the middle there, but other than that, it's fairly open, and kind of no products here in the middle of the low end, and that's fine. On the other hand, you see it looks like 1, 2, 3, 4 products that might be moving into the low end. You know, they're staying static. The low end might be moving to meet them. How's that? Okay, that's kind of my guess as to what's going on there. So, and you got some products here that maybe are in the process of exiting. You know, Acre is in that dotted line there, and I think it says if you get outside of that, the odds of selling anything are pretty remote. HR summary. So we see, you know, Baldwin came along and made some investment there. Erie's continuously made some big investments here, and it's up to 112.4% productivity, and Ferris only 104. Now that, you know, lends to labor cost, okay, and you might want to go check out Erie's labor costs, and you might want to take a look at Erie's contribution margin that has maybe been enhanced because of some improvements in labor cost. So it's up to you all. Labor contract, we are going to have that in the 6th round, so just starting to kind of let you know. Andrews did make some nice investments here, Baldwin a little bit, and there is some improvement. But look at Erie. You know, huge investment, really, 13.5 million, and 10 million more than Ferris. Okay, I'm kind of willing to tell you here, you know, that if you took that out of the equation and it made no other difference, it does make other differences, so it's hard to say. But if you took that out of the equation, without affecting other things, you know, Erie's profit after tax would have been close to Ferris then, right? Because this is unlike plant improvements. This is a direct cost. This is a direct expense. Okay. Now, that said, it's offset by, look at that, big material cost reductions, big labor cost reductions. Okay. Here is maybe a reason Erie can push Ferris in that high end and some of the other segments. They reduced their R&D cycle time by more than 25%. Okay, so that means that if it takes a year, say, for Ferris to revise a product, Erie could do it in 9 months, or alternately, Erie could revise a product further along. Okay, it could make bigger revisions, and the revision date might then be equal to Ferris's 1 year, for example. Okay, and some reduction in admin costs, which are huge, and then big increases in demand as well. And so, big investment cost money. You know, I'll come up and look at the income statement. Sorry, I got to go way up to do that. But other fees, write-offs, TQM, and bonuses, and there it is. You know, along with some other little things, and we see, you know, and so, yeah, remember what I said, that they might, appreciation, other, yeah, if you just took, you know, that, yeah, they wouldn't quite be the same. I said that they'd be close, but if you took the roughly 8 million difference there and added it there, Erie would have been pretty close to Ferris. Okay, and in fact they'd made up for it a little bit here in interest, and so it would have been a really close match. Okay, maybe, and I say maybe because again, that's discounting the positive effects that investment that Erie made should have had, did have, okay, and will have. You know, there again, those investments pay off for the next now 4 rounds. Okay, and so, you know, you could do some math on that. You sharpen your pencil, and you wouldn't have to get it real sharp to come up with some pretty good answers there. Okay, well, that's kind of it. So, you know, let's take a look at the assignment for next week, and then we'll see who won. So, why did Andrews have negative contribution margins for its products, Acre and Atom? So they had 2 products here that had, ooh, shoot, didn't want to do that. Acre and Atom, if you come over here, negative contribution margins. Now, and I put this right in the question, the price here is 20 bucks, and you know, looks like material and labor costs are about 11. So they had a $9, you know, positive there, so that wasn't it. And on Atom, you know, it's similar. There's about a $20, roughly $19.50 labor and material costs and $30 price, so still positive in that sense. But why did it have end up with a negative? Okay, and that you ought to be able to tell me. Okay, it's kind of interesting why that one didn't too. But hang on a second. Sorry, I got interrupted again, but I think I was getting ready to go over the homework. So again, I said, why did Andrews have negative contribution margin? And we'd kind of gone over that, right? Okay, so yeah, take a look, do some thinking about that. You might want to look in your guide, you know, I mean, just kind of read through it, and things that would, you know, contribute to a contribution margin. And I think, like I've told you in the past, there's really only 2 things. One is price, and the other is variable costs. So, okay, 2. What factors contributed to EB's 53% contribution margin in the low end? So on the opposite end, wow, EB had a 53% contribution margin. Okay, there's several factors. Okay, so, you know, make a good list. I'd tell you that if you get 2, you might be half right on the question. Okay, but probably not. So it's probably a few, more than a few. Yeah, more than a few. 3, what are the reasons for acres poor sales in the low end? And you'll see that reasons is plural. Okay, so again, you know, 1 or 2 things, yeah, it's going to take a few or more. How's that? A few or more. I like that. Okay, and then 4, I told you I was going to ask this one, but Erie spent $13.5 million roughly on TQM. What were the short-term implications for product? For profit implications. Gosh, I'm spelling out. Okay. In other words, what were the positives and or negative impacts to profit? Okay, again, numbers could be used to answer this question. I might consider some bonus points if you provide some numbers, right? But they aren't absolutely necessary. Just well thought out, just well thought out explanation of what types of things could happen that would affect that would be affected by an investment in TQM. Okay, well thought out and explained. Okay, so good deal. Not too bad. A little over half an hour. We're halfway home in the competitive rounds. I did want to talk a little bit about the CompXM. I see 4 of you have signed up for that. Doesn't look like you've begun. I might, in fact, I'll probably send out a note with this that requests that everybody be signed up for that. I just want to make sure we don't have any hiccups, okay, along the way, and so I will do that. And let me know if you have any hiccups getting signed up. And then my advice is, go ahead and get in there. Start spending a little time. It's going to take you, 5 to 8 hours has been the response in the past. So it's going to take you a bit to get through that, but you can stop and start. So you don't need to set aside an 8-hour block. You just need to maybe set aside blocks of 45 minutes to an hour to kind of work on it. So have at it. Good luck. Good luck in round 5, and we'll talk to you next week.